Hi everybody, currently we are still in the bear market. However, my stock portfolio have managed to turn positive. And today I'm going to update you on my stocks and unit trust portfolio, plus also share with you what is the US stocks, Singapore stocks, and the unit trust that I have added into my portfolio. Now let's look at my stock portfolio as of 8th of August. The capital invested is 31,000 and the portfolio value is $31,068.06. So it have a slight profit of $68. This shows the amount of top up that I have done for this account since it started in 31st of December 2021. Every beginning of the month or end of the month, I'll top up $2,000 and middle of the month, I'll top up another $2,000. So the total value I top up into the account is 31,000, and with the value of 31,068.06, I'm actually make a profit of $68.06, or is actually 0.22%. Let me talk about the two counter that I've added during this period from my previous update. The first stock I added is called Johnson&Johnson. I think this name will be very familiar with most of us. It is a healthcare giant in the market. Its main business are mainly divided into three parts. It's called the worldwide consumer health sales, worldwide pharmaceutical sales, and worldwide medtech sales. So these are the three main parts of Johnson&Johnson. And one thing about Johnson&Johnson is a lot of dividend investors like Johnson&Johnson because it is one of we call the dividend king in the market, where it had 60 consecutive years of dividend payout. And it's not just dividend payout, it's 60 consecutive years of increasing dividend payout. So what does it mean? That means if you buy Johnson&Johnson, this counter, you're almost for sure that every year the dividend will just increase. And you have done that for the past 60 years. And not many of the stocks in the market are able to have this type of fantastic track records. They are able to do it because of the nature of their business, plus they have a very strong balance sheet, which able to result them to able to pay dividend for 60 years, despite the market go up or come down. And one new development of Johnson&Johnson is they're going to spin off their consumer health group to a new company in 2023. This is the lower growth group in Johnson&Johnson. By spinning off this business group, Johnson&Johnson will mainly focus on their higher growth business, which to me, it will be a positive thing for them to continue to generate a growing dividends for the investor. And I believe Johnson&Johnson will continue to do well during this inflation period because large portfolio of them are non-discretionary goods because are healthcare products where people need it and they need to consume it and they need to spend on it. Although when I invest in US counter, my intention is not for the dividend due to the 30% withholding tax. I'm more looking at towards the capital gain side. But if you invest in a dividend growth companies, you see when the dividend grows, the share price will actually also grow in tandem. And this is the stock chart for Johnson&Johnson since 1982 to current month. They have outperformed the S&P 500 during the same time frame. The second stocks that I add on to the portfolio is a Singapore stocks, which is called SATS. I bought these stocks as these stocks have a very good track record of increasing dividend before the COVID. And they actually have suffered quite a lot during the COVID period. And now the economy has started to open up and we're living with the COVID. I believe these stocks were able to pick up and go back to the good old days of increasing dividend payout. However, SATS have just recently announced their Q1 earnings in July, and their revenue actually have grown by 36.2%. However, due to higher costs, especially the higher staff costs, their PATMI actually have dropped much more on a year-on-year basis. So this is just a first quarter highlight of SATS financial data. We can see that their revenue actually have increased by 36.2%. However, their operation expenses have increased by more than 50% due to the open up of the economy where they hire more staff and also plus some inflation pressures, which resulted in their operation expense have increased drastically. Furthermore, the government relief also have cut compared to 1 year ago. This have actually resulted in a negative core PATMI of 22.5 million compared to 1 year ago where it's a positive of 6.4 million. However, we were to exclude the relief, the PATMI actually have improved by 10%. Nevertheless, the company is still suffering losses and will not expect them to pay dividend anytime soon. This is a chart to show that how SATS have performed on a quarter by quarter basis. We have observed that for over the past 5 quarters, their revenue actually have increased quite a fair bit. However, their PET may have a drastic drop in the latest quarter due to the reopening, due to the sudden surge in higher operating costs. But with the continued opening of the economy and more air travel traffic, and plus a cruise line also, I believe SATS were able to turn profit in the foreseeable future. Now let's look at the individual stocks performance compared to the market. Let's look at the 4 REITs that I hold in the portfolio compared to STI. Currently, all the 4 REITs based on year-to-date underperform the STI. As we know, the interest rate is going up. So a lot of people are concerned about REITs because REITs are always on leverage on gearing. So actually for REITs performance for year-to-date compared to the STI, it is not that fantastic. From here, you can see the STI actually have up 4.36%, but the REITs that currently that's positive is mainly Ascenders and Mapletree Pan Asia Commercial Trust. And both the Mapletree Logistics Trust and the Parkway Life REITs are still negative year-to-date. However, based on the past history of track record, actually REITs usually will perform well in an interest rate rising environment over a long-term basis. Let's look at the 2 SJ stocks I have, which is SATS and OCBC compared to STI. For OCBC, actually, it performed much better than STI. SATS performance is pretty on par with STI. Now let's look at the US stocks. Let's look at the 5 counters that I have that is listed on the New York Stock Exchange when compared to the S&P 500. That Johnson&Johnson and Visa outperform the S&P 500. Despite their year-to-date return is still negative. However, the S&P 500 year-to-date return is minus 13%. But the JP Morgan, Disney, and Nike lost about 30% year-to-date. In a nutshell, that my US shares that listed on the New York Stock Exchange have underperformed the S&P 500. Let's look at the 3 counters that's listed on NASDAQ when compared to S&P 500 and also compared to the NASDAQ composite. All the 3 counters actually year-to-date are giving negative returns. However, all 3 of them, Costco, Apple, and Microsoft, all actually have outperformed the NASDAQ index. And Costco and Apple have also outperformed the S&P 500 index. But nevertheless, all are negative. And thus, which is why you see that my US stock portfolio currently is in the red. Currently, I have close to 48% of the money is parked under the money market funds. I will slowly deploy more of them into the stock market when there's opportunity. But the current strategy will still be holding at least 40% cash, as we are still not out of the wood yet, as there's no clear sign that the market have really bottomed up. So I will want to be more cautious on that. Now let's move on to my unit trust portfolio. The capital invested as of 8th of August is $21,000 and the portfolio value is $19,399.76. So my unit trust portfolio actually is still suffering a capital loss of more than 7%. For the unit trust portfolio, every beginning of month, I will do a dollar cost averaging of $2,000 into the portfolio. And also in the middle of month, I will do an ad hoc lump sum top up to selected fund. And based on the current market value, I still have a loss of $1,006, and which is around 7.62%. This is the unit trust performance of my 5 core funds. All the 5 funds year-to-date performance are all negative, with the Infinity US 500 stock index dropped the least, which is down around 13%, which is in line with what S&P 500 have been performing, followed by the FSA Dividend Advantage, which is down slightly more than 15%. And the other 3 funds actually have down more than 20%. From here, we can see that they have actually started to recover and they start to bounce back, especially the technology fund. We have a worst case down more than 30%, and now actually they've recovered more than 10% on that. And actually, I have added one more unit trust fund, Nikko AM Shenton Global Opportunity Fund. Why I decided to add into this fund? Because UOB United Global Quality Growth have a soft closure that do not allow investor to do regular top-ups to their funds. I can only do a monthly RSP top-up to their funds. So, but I still want to maintain at least 30% holding in the global fund. So I look for an alternative fund to run parallel with the UOB United Global Quality Fund. And this fund I selected is called Nikko AM Shenton Global Opportunity Fund. Based on the fact sheet, we look at this fund on the long-term basis, 3-year, 5-year, and since inception. You can see that their returns based on the NAV to NAV actually have outperformed their benchmark, where their benchmark actually is the MSCI World Index. However, on the shorter term side, on the near term side, because of market volatility, this fund have underperformed the benchmark. when I invest in unit trust, I usually looking at the longer term side, and they have a long-term track record. They have actually beat the market, and thus I decided to put in this fund in. When looking at long-term perspective, this fund is one of the top few funds that constantly outperform the market. But one thing to take note is this fund, the fund size is relatively small when compared with peers of other global funds. One of the key reasons, maybe this was initially a Singapore fund house fund, which last time is under DBS Asset Management. Then it sold off to Nikko AM. It is a Japan fund house. So they are pretty Asia focused, where the big names are mainly in the west side. Thus their AUM is slightly much bigger. This is an illustration of the top 5 holdings of the fund, where Microsoft is the top holdings, and it is very US focused, where 70% of the holding are US counted. Now let's look at this fund performance compared to UOB United Global Quality Growth Fund. From here, we can see that Nikko AM fund actually year to date performed better compared to the UOB fund. Do take note there's this thing called ACC and DIS. What I invest in is the DIS fund. DIS fund, the performance is lower than the ACC. The key reason is DIS is a dividend share class fund where they pay out dividend on a monthly basis, which is why the performance is lower than the ACC, which is a dividend reinvest. Thus, actually, the performance is the same. It's just a dividend is being cashed out. But for my case, I reinvest the dividend. So actually, we can use the ACC as a reference. But nevertheless, they still underperform the Nikko fund year to date. So this is an overview of my current holding, where I have 6 funds. All are actually negative, except the Nikko AM Global Opportunity Fund, which I just started to invest in June, and it's actually up 3.2%. However, you can see that losses for the whole unit trust portfolio actually have decreased over time. One thing is due to the market has rebound quite a fair bit. Plus, I do a dollar cost averaging to average out the cost, which resulted in the loss have reduced quite a fair bit. I will still continue to maintain the strategy of doing dollar cost averaging and also doing a mid-month top up to this portfolio to average in the cost and to ride the wave of the current market. And that's all I have to share with you today. And if you feel that this video has benefited you, do remember to like, share, and comment on this video. And lastly, do remember to subscribe and press the notification button so that you'll be notified on my next video. I shall see you in my next video. Bye-bye.